Welcome to the part 2 of this video. So this is the part 2 of day 4 investment appraisal. I stopped in my part 1 video. I stopped in annual tax relief. So here we are going to discuss how annual tax relief you have to work out. It's very important for adjusted present value. So here we have subsidized loan and then remainder of the loan, right? Because even for the remainder of the loan, we are going to have tax relief because the interest we are going to pay on that loan, we are going to take the amount which we have to finance this project. Our initial investment plus working capital is the amount you are going to take as a loan. So when you are taking a loan, you have to pay an interest. So that interest is also, you are going to get a tax relief on that and also on the subsidized loan. So these two loans you will be getting tax relief. So here subsidized loan, here it is just 80%, remainder of the loan will be 20%. Here the rate is 5.5%, here the interest is 7.5%, but the tax rate is 25%. You have to add both. After that, don't forget to discount it, right? You have to discount it at this rate, 4.5% for years. There are so many assumptions why this rate, why not 7.5? There are so many rates which you can take. You can take 7.5 or 4.5. Please read the notes below the assumptions and all. And it's for 4 years, so annuity factor, because interest you have to pay for 4 years, right? Interest annually you pay the same interest, so that's why you have to take the annuity factor, which is this, and then you find the present value of tax shield. Very important that you exactly know how to find the present value of tax shield. If you don't know this, your adjusted present value calculations will go wrong. So this present value of tax shield, let's go up. Tax shield on debt for their working 6, this has to be there, and then the subsidy benefit. So all this will add up, and then we are coming to part B. Here we have some assumptions, as you can see. So please go through the assumptions, right? And also these are some further assumptions. So with this, we finished the 25 marks question series, and now the question which I'm going to discuss from now onwards, from 48 to 53, are 50 marks question. So starting with 48, right? It's a big case study. I'm not able to put all the case study. So it is, even though this looks very shocking, right? Why financial reconstruction? Because I told you investment appraisal can come in any topic. It will combine and come in mergers and acquisition. It can come in your exchange rate risk management. It can come in your reconstructions or reorganizations, right? So here this is a 50 marks question. The main theme is financial reconstruction, but part of it is also there for your net present value, right? As you can see, you are given the balance sheet, then you are given some figure. You are given this bond. Because of that bond, because for this bond valuation, you have to know how to do bond valuation from your investment appraisal lecture, but you have to apply this in your reconstruction, because in your reconstruction your bond is going to change. Bond comes under debt, right? So we know that in reconstruction, debt increase, reduce, we change the debt. So that debt is calculated by bond. So that bond valuation is important. Previously we have seen in 25 marks question how bond valuation is done, so I'm not going to waste my time here on doing that. Yeah, the government yields have been given for the 5 years and you have been given the rates. So next, so let's just read the requirements. The first requirement, A, is not relevant. It is about how they can benefit from high level of debt with respect to risk and protection against acquisition based and tax benefit. This is a theory question, right? Let's come to part B. Part B, right? When you're coming to part B, only this and this are relevant for your investment appraisal, for your bond valuation, right? Estimate the briefly comment on the change in value of the current bond. So this change in the value of the bond is a key area. Let me put a highlighter. And coupon rate required for the new bond. So first, change in value of the current bond and coupon rate for new bond as requested. 6 marks is there. And the next one is Macaulay duration of the new bond based on the interest payable annually and face payable repayment, and the Macaulay duration based on the fixed annual repayment of interest and capital. So the other one is fixed annual repayment of interest and capital. So under this two, you have to know how to find. And the next ones are, we previously have done it for reconstruction and reorganization. It is not relevant for this, right? So all this we are not going to see. Now you see under appendix how it is marked. If you see the appendix clearly, when it comes as a 50 marks question, the main theme might be reconstruction and reorganizations, but the small workings you have to do. For this, you need the knowledge of investment appraisal. You need the knowledge of bond valuation, starting with appendix 1. Why? You can start this later also, because you need that bond valuation. Bond comes as a debt in your balance sheet. You have to change your balance sheet. It's going to have an impact. So this bond is going to have a huge impact in the balance sheet after reconstruction. So you need to first value the bond. That's why the requirement is also given in that order already. The way the requirement is given, this is number 1, this is number 2, this is number 3, this is number 4. When you are making a report, you have to write also in this paragraph in this order. When you are doing the appendix also, you have to show your appendix in that order. So first you have to start with the bond, right? Already they have given, right? Here you can see it is 1.5%, right? 1.5%. So with that you keep on adding whatever the rate. If let's say it is 8, so with 1.5, 40 basis will be added. 1.5 plus 0.4, 1.9%, like that, like this. For second year's rate will be added, like that. It keeps on adding. So make sure that you know how to find that. So here, based on this rating, these are the rates, 5 rates. You need the 5 years rate to value a bond. Next comes using this -1 or 1 over that rate is the same thing only. Here, now you're only using it for 3 years. Here it's 5.57, 5.57, 105.57. So we'll check that. By now you should be quick enough to know why it is 5.7. Yes, so here coupon was 5.2%, non-current it includes coupon. Here when they give you the non-current liability, they just give you 120. So from here you are not able to get it. So here they have given you 5.2%, and also they told that they are borrowing increase, the coupon payable on this bond will increase by 37 basis points. That's why 5.2 plus 37, which is 5.57. So that's why you are taking here 5.57, 5.57, 105.57, and then you're getting this value. Once you get that value, the current bond value is this much. The current bond value is already given to you because you want to find the change in the value, right? 107.8 per 100, right? So that is the price of the bond. It's already given. And if you see the one which you have calculated, you based on this rating, it is almost same. It is almost same. Now, so this part is over. Next part is the coupon rate required for the new bond. See how they have used it in subheading? The different requirements you are giving at a subheading. Your subheading very specific to the point, not lengthy subheadings. Don't waste time in beautifully arranging your subheadings, writing lengthy subheadings, or copy pasting exactly the same required. No, coupon required for new bond. You have to specify for which bond. If there are 2-3 bonds, remember this. If there are 2-3 bonds, always say which bond you are talking about. It's easy for you to get confused. Which bond you are dealing with, because let's say there are 3 bonds, you don't know which bond you are dealing with, you don't know for which you are finding coupon rate. Maybe you might have to find out of the 3, maybe for 2 bonds you have to find the coupon rate. So you can name it like bond A, bond B, or bond 1, bond 2, bond 3. Usually it is numbered like that. Or you can say old bond, new bond. Okay, so coupon rate required for the new bond. Now whatever the ratings here you have, because you are paying fixed interest rate, not here. If you see here you are paying this, second year you are paying this, third year is variable interest rate. They want fixed rate. So with fixed rate, your rate will be fixed, but this rate, R, the coupon rate they require. So coupon rate will be fixed. So this, right? New bond means, so for that, because we know that coupon into this, coupon into this, coupon into third year, coupon into fourth year's value, and coupon into this one. Fifth year, it will be 100 also with the coupon. R is your coupon rate. And if you see this and this will be same in the fifth year. It will be equal to 100 only, because you want to find per 100. So now, what do you have to do? What do you have to do? Just simply add okay, wait a minute. I think somewhere R is not okay. So when this I copy pasted it, I didn't include here later. But here R was some rate. You have to find that R. That I didn't include it here. So coming to the next one, McCullough duration also you have to find out based on that. Here 4.7 year. Next. So McCullough duration based on fixed annual repayment of interest. So fixed was 3.5%. This was the rate which you got from here when you solve this equation R, right? So this was the rate for 5 years. Annuity factor because same. So then if you have to get it out, it will be this. So if you want to get required to pay back the new bond issue, 100 divided by this 4.5, this will be the price. Now using this price, you have to find the McCullough duration. McCullough duration means what you have to multiply. So this you have to multiply each year by the discount factor. 1 year, 2 years, for 3 it is 3, for 4 it is 4, for 5 it is 5 divided by 100 is 3 years. Make sure that these steps are there. Numbers. Don't just try to put everything in a calculator and just get the final answer and put it. So coming to the next one, there is an alternate presentation of duration calculation. If you haven't understood previously what was it, then this is another method. I think this is an easier method because this is the one which have been taught. First fine, it is 3.5%. So 3.5, 3.5, 3.5 coupon rate. Last year it's 100 plus 3.5, so 103.5. The discount factor. Get the discount factor. Once you get it, find the present value. And present value as a percentage is this. Total present value. Once you get it, multiply it by number of year. 1, 2, 3. Add and you will be getting the same. Same wise for the even next one you will get 3. Right? So now coming to the appendix 3. So rest all is for your reconstruction. So only this much is for investment, this bond valuation. Coming to question 50. So this is an international net present value. As you can see, inflation is given of the two countries. Inflation is given throughout the year, right? Here you have an opportunity to carry forward the tax losses. And also zero corporation payable is first 2 years. First 2 years you don't pay any corporation tax, right? And then you are given some facts about this company. You have been given the sales component unit, the price, the inflation. If you see, it is in different currencies. Some are in dollars, some are in the other countries currency, foreign countries currency. So it's many currencies are there, right? That's why if you see here, even the current spot rate, you should know how to deal with it. You have been given the current spot rate, you have been given the rates, right? You have to use this exchange rate to convert. Next, you have been given the inflation rate for US and for EU. And what are you required to do? The first is A. It is not required. It is a theory part that you shall be able to do it. Coming to part B. So my focus is part B, financial acceptability. In assembly plan and this. Clearly net present value. Assumptions made. You have to also make your assumptions. Make sure you discuss your assumptions. Because when you calculate in net present value, there are so many assumptions. Some are general. Always you can write about. Some are specific to the case. So make sure you know those. We are not going to cover it here. And also other risks and issues. Then a reason recommendation has to be made whether they should invest in there or not, just for 3 marks. Make sure that you follow the report in the format. So I didn't include the report here, but appendix part, yes, I did, because I just want to show you the calculations. So I can quickly go through, because all these are similar like before. You start with sales revenue, working is there, then part cost, then deduct variable cost, then fixed cost, then royalty fee. Royalty fee is another right? For this also separate working is there. Tax allowable depreciation, no working is there, just 4,500, same. Then you get taxable profit. Here tax loss can be carried forward. This loss can be carried forward, not in year 2, in year 3, because they told first 2 years no corporation tax payable. So in year 2, that it will be carried forward, and then 40% tax on this. So it's 0 here, 0 here. That is the little difference here. And make sure that you write in the currency. And then you have to add back, how you add back the depreciation, you have to add back the loss carried forward also. Whenever there is some loss carried forward, it needs to be added back for you to get the cash flow. So cash flow you get after tax, then your working capital comes, and then your land and buildings you deduct, and finally you get the cash flow. But this is in this currency, you have to get it dollar. If you have to get in dollar, use the exchange rate given, right? Use the exchange rate. But the current, if you see 120.1, so they have used this line. What about year 0? What about year 0? How did they get that? It's this from here, 101.4. Current spot rate means for year 0. So using it, convert to dollar. Once you convert to dollar, now as you can see, there are some contribution part sales which needs to be added, because from dollar they are making contribution. They are selling this part and they are having a contribution on that. That's why it is added here. Even the royalty they are receiving. They are receiving royalty. But for them, if you see here, there's a royalty fee which is deducted here. This is when it is in foreign currency, because they have to pay a royalty fee. But here it is receiving. They are receiving royalty, because of course one company, the royalty will be payment for that, the other company will be receiving. Same for the contribution. Next we have the cash flows. Then don't forget the tax on contribution and royalty. Why? Because already you have paid what? You have paid a higher amount of tax here. 40% tax you have paid here. 40% of tax. And here if you see, it is just 20% tax. So already higher amount of tax you have paid in foreign, because of double tax treaty, you don't have to pay any tax here. But on contribution and royalty, it's in your home country, you have to pay tax. On that 20% tax you have to pay. And then take the cash flow, find the discount factors given, find the present value. And if you see the net present value, it is this. Also, there is a small paragraph which talks about loss contribution and redundancy cost. Why loss contribution? If they invest in Elandwy, they are going to lose the contribution which they are going to make. And also redundancy cost is there, which if you take, they have given you some net present value, just add all, it adds up to 0.1 million, which is small, right? Minimal impact it will have. So here the workings are there. You can see separate workings are there for finding sales, cost and all, right? All the selling price, it has been inflated. Make sure you know how to work with inflation, because inflation, always they will give you figures where you have to inflate. Then the part, then the variable cost. All these are the cost terms. So now when you have to find the sales revenue, it is your sales volume into price. This is exchange rate, because it is in this currency, you have to take it in dollar, right? Part cost also in another, part cost might be in another currency, sales revenue might be in another currency. So that's why when you change, here is 165, here is 121 point. Be careful. Here you don't have to change at all. Here if you see variable cost, no currency is there. Old cost into volume. Why? Because it is already in that required currency. So you don't have to change variable cost. Sometimes you don't have to. You can use as it is. Third, let's come to royalty fee. Just convert it to dollar, which is 36 million, right? Then contribution from paths. Make sure that you know this. Contribution is an area where students struggle a lot, especially when you have some contribution from by small part. So you have to find the revenue, you have to find the cost and contribution per unit and the total contribution, right? So definite is the sales volume into that price minus the cost and then contribution per unit and then total contributions. So that's it for 50. Coming to 51. 51 project cost of capital, Appendix 2.1. So here you have to find the project cost of capital. So this is an answer. Let me start with this is the question. If you see here, you have been given the cash flow. The initial cost has been given. This is after tax cash flow for 4 years. This is an acquisition and merger question, but it has an investment project in that. Before going for acquisition, right? Before or after, I'm not sure. I don't remember, but yes, it is an acquisition question, but it also has this part. And this question is unique because it deals with probability, expected value. You should also know how to deal with expected value and probabilities. As you can see here, 25% probability that industry will not grow, 50% that it will be original. So you should know how to deal with these probabilities and all. So now let's go up and show you. As you can see here, project cost of capital. You should be comfortable with all equity beta, asset beta, then the current market value of bond. By now you should be familiar. And if you go down, they have got a WACC of 15.14.2. Then let's go to Appendix 2.2. Without the offer, what is the expected value of the project? So cash flow has been given, discount factor you have just found out 12% here previously. Okay, I didn't include that, but then you have the present value. Once you are given the present value, the probability, they give you the probability. They told in year 2, 3, 4, it will reduce by 20% if it is not expected as the first year. So that's why it is 0.8 you are taking, multiplying. But first year is 1%. Sorry, 100%. That's why probability is 1. So you have to find the expected value. And once you find the expected value, present times, 40 times from 2 to 4. And then so total expected value, you should know. You add all, that is your total expected value. There's a 70% chance of this occurrence if the first year is not as expected. So if the first year is expected value you have to find out. If it is not first year is not expected, then what is the present value? They told present value will fall 50% by the original. So just take 50% of it, add it, and this. There's a 25% chance of this occurrence. Exactly. 75% of chance of occurrence as not expected at first year means 20% chance. So overall present value of the project inflows, you take 75% and you take 25%. Something of occurring. Right? If 75% is not occurring as first year, 25% is occurring. Like that. So now this is your project net present value. Deduct your initial investment. This one is your project net present value. Right? That is without the offer. With the offer, if you have to take. So the present value 50 million, you have to discount it. Right? Once you discount it, what do you have to do? If it is not expected, then this will be the present value of inflows. Coming to 52. So here also you have been given some, it is also a project, the option. As you can see, standard deviation is there, right? Exercise price is there. They have been given time. Now, discuss the role of WTO, possible benefits and drawbacks to the company of reducing protectionist measure. This is something a pure theory question. 9 marks. So coming to part B. Since it is in a report, right? Value of the project before considering the offer, estimate of the project or value of the project after the offer, and then assumptions made in both the parts with additional business risk and all. So starting with Appendix 1, it will be excluding the project. Excluding the project means just the net present value you have to find out. So here also if you see sales revenue, production and selling cost, special packaging cost. Sometimes you have special packaging cost. For them also it's a working. Training and development cost. If you see training and development cost here, but it is 000. Tax allowable depreciation. You keep on deducting. Here you have a balancing allowance. Why? Why is it? Just so when you add all this tax allowable depreciation should equal to your asset on which tax allowable depreciation you have taken. Don't forget to add it back. Then taxable profit comes, then your tax you need to deduct, then your depreciation you need to add back, and finally cash flow but in this currency. Now you have to change it in dollar. So all amounts are in this one. Use the exchange rate. Okay, this exchange rate also you did a working one. You have to find exchange rate during your working. Easily you didn't get. Then convert it to cash flow, then discount it using discount factor, and then find the present value. This is the present value. Next, if you see, you didn't hear, if you see there is no zero, right? This year zero is not here. How come? No tax, because that is because all this cost and sales is in one currency, and this is, it is in a different currency. Land and building, right? So here they have shown it separately. So present value of land and buildings in year 5. 80% they told it will be there. Land and buildings plus machinery. Divide by this. This is your, you want to convert it using this. So if you put this as year 0, in year 0 we know that discount factor, we don't discount it, it will be the same amount only because discounting factor is 1. So that's the biggest reason, since it is in year 5 and we need to discount it back to year 0 from year 5. That is the reason we have taken it separately. We haven't put it in the table format in year 0. We have to take it 0 point for the 5th year's discount factor to find to the present value of year 0. This is the present value of land and buildings which needs to be deducted, right? Because it is present values of cash flows, it is not net present value. Then we have to find the present value of working capital separately. Working capital is 200. Again convert and into the same. So cost of initial investment, if you have to get initial investment, that will be this 2,500,000, your land and buildings machinery, and your working capital divided by your exchange rate, current exchange rate, and then this. So now when you have to find the net present value of value, how much it will be? Present value of cash inflow. This is the present value, this from selling of your land and building and machinery. Then this one is from your working capital. And then this is your initial investment. So this is in negative. So make sure that working also, if you see here exchange rate, what you have you done here? You have been given this rate already. Rest all you predicted using purchasing power parity. It is known as PPP. Purchasing power parity means you are using the inflation rates of the two countries to predict the exchange rate. Then sales revenue, right? And when you're putting this, increasing it, don't forget to put the powers. Very important. Please write the currencies all the time. This is an international net present value question. And why exchange rate has to be done first is because everything which you need later needs to be converted using exchange rate. So keep your exchange rate ready. Then special packaging also. Then comes to Appendix 2. Appendix 2 is your using Black-Scholes option pricing model to value the project. Right? Value of the underlying asset, PA. How will you get this? It is this. Sum of the present values of cash flows. Here they have written foregone in year 3, 4 and 5. Right? And this is the price, exercise price. Then this is the risk-free rate. This is the standard deviation. This is the time. Using all this, now you can find D1, D2, ND1, ND2 and value of the call options. This is a put option. So you have to go further and find the put option. There's a formula for that also. So once you find this is the value, your net present value was negative. It was this much. So that needs to be deducted from the call option and this will be the total value. And then you have to recommend. Coming to 53. Here if you see this is an exchange rate risk management. In this how they can bring out investment appraisal question we'll see. So all these things are not needed. What is here is important. It starts from here. The AFM project information. They have given you all this information. So that means this table you don't have to create. Some notes is there. Look here. This is already incorporated into the estimates above. You don't have to go and change this figure. But these are the figures which are not incorporated. This you have to go and change in the table above. Right? So now we'll read the requirements. So A. Discuss how investing in overseas may enable them to gain competitive advantage over its competitors who only invest in domestic projects. Theory, purely it is theory question that you shall be able to handle it. Coming to B. Advantages and disadvantages of exchange rate rate compared with over counter. Very common question. Make sure that you know it. Part C. Prepare report for the board of directors. Right. So first part is hedging choice. Which hedging choice you will use to hedge it. And the additional debt finance needed to fund the project for the preferred head choice. Let's say you are using preferred head choice. If you are using future, so that amount will be used to finance the project and any additional debt more than that if it's required, that will be used as a debt finance to fund the project. Then estimate the net present value of the project. In Japanese yen. In which currency? Japanese yen. Based on the end of year 1 being the start of the project. Then evaluate choice, the debt finance needed and whether they should be undertaken. You have to consider both financial and non-financial factors. When you give questions answer like this, don't forget to mention the non-financial factor because it's easy to give financial factor based on calculations, but non-financial factors rarely students talk about it. So now coming to part C. My focus is all in part C. This is the report. I have given a full report here just to show you how a answer for a 50 marks question comes. So here you start with introduction, then evaluation, which choice and how much debt is required. Then the third topic is evaluation. See, this part of the report talks about evaluation of the Heron project. And conclusion and recommendation. So debt finance is required. How much? If you see from your cash flow, investment amount required is this 10,150. Right? Can we see here? Exactly. This is the amount you require. So this 10,150, you have already calculated the exchange rate using it, convert it to Japanese yen, which will be this much. So from this much, out of this 13 already, you can utilize from this. Out of this, you can utilize this by from your future. You will get. So additional as only this much you require by debt. Right? Next, you have to find out all the inflows and all. And this are your loss contribution you have to deduct. How much you're losing in Japanese yen. Next, the tax saving on loss contribution. If you are losing contribution, remember what happens. You are going to save tax because if you are having contribution on that, you have to pay tax. Whenever you make a profit or a contribution, you have to pay a tax. But since you are losing contribution, you don't have to pay tax. Tax is saved. So it's added. Next comes your contribution component. It's here. On that you have to pay tax 30% and additional tax payable. You have to pay additional tax working 3. Why additional tax pay? When you pay less tax in foreign, when you come to home country, you have to pay more. The remaining tax you have to pay. Right? That's why it is this. Working is there. Net cash flow. Discount using present value. This is your expected net present value in negative. Now we'll show the workings. So you find out the exchange rate using same purchasing power parity only. The two inflation of the two countries. Once you get it, you find the component contribution. Right? How you get the contribution here, it is not straightforward. Usually it is revenue minus variable cost. Here you have been given the revenue and you have been given the contribution percentage. That means on that revenue after inflation you have to take 25% on that. That will be your contribution. And then additional tax payable. Right? So additional tax payable on what? On this pre-tax profit. On that additional tax is there, but you have to first convert it to Japanese yen because it is in this currency. Then pay 15% on that, which will be your tax. Right? For D is a theory question. And coming to question 54, this is the last question. So as you can see here, revenues and cost apply. You have been given the unit cost, variable cost, and some contribution has been given, total fixed cost is given. All this is given. So coming to part A, we can just go through it fast. Part A of the first part says whether they should take the project or not and cease its production in US immediately. Assumptions also you have to talk other than financial this thing. Coming to the next one. It is suggested that financial assessment should be based on present value of operating cash from the Gamaliel discount when appropriate, all equity rate and adjusted by present value of other cash flows. Now coming to the second, discuss the potential change in government and other business factors. So this is a theory question. You in a net present value investment appraisal, you should be ready for such topics like what happens if government changes, all macroeconomic factors. What are the business factors, business risk, legal risk, all these things based on that particular industry. Next, right? So the B part and C part we are now going to cover here. It's a theory part. So let's go to the appendix. You have been given this currency starting from year 0, sales revenue, deduct variable cost, imported component, fixed cost. Then you get profit before tax. On that you pay tax, investment, working capital, cash flow, use exchange rate, convert it. So all these are similar to you. By now you're familiar. Use exchange rate, present value, working is there. Then find the net present value. Now you have to find adjusted present value also in this question. So this is your base case net present value. Just now we got. On that, what do you have to do? It's added 2 times, it's just added 1 time. When I copy pasted it, it came again. So additional US tax you have to pay. Opportunity cost and additional component contribution. All this are there in working 7 which you need to deduct. Of course, when you are closing in US completely, revenue minus cost you have to take into account. And tax shield, definitely. Adjusted present value means tax shield will be there, subsidy benefit will be there, which needs to be added back, and this is your APB. Now this is how you have to work out your exchange rate risk. PPP only, purchasing power parity. Sales revenue also, price is there, volume is there, inflation is there, or exchange rate is there. Here it is already inflated, you don't have to inflate. Even though inflation is there, the amount of inflation is there, the rate. So variable cost also the same way you have to do, right? Imported component also same way you have to do. Inflation after year 1. That's why you're taking here this 3%. Then comes to taxation. So taxation here also you can carry the loss forward. Right? First you find profit or loss. Here it's a loss. So it's a 0. It will be loss. Second year, out of the 7, fully you are utilizing the 7, so you are left with nothing. Your loss is little bit reduced, which you have to carry forward and you adjust here. Next, your discount factor. So all this working is there to find the discount factor. So coming to part 7. Additional tax. How you do that additional tax? Opportunity costs, additional contribution. Then you find the total cost on that 7% discount and find the present value. So this is the total present value negative. And how you get that additional tax? Taxable profit divided by exchange rate into 10%. And if you have to find this opportunity cost, it is unit into contribution into 1 minus tax rate. Then tax shield and subsidy benefit. Right? So this is the annual tax shield, annual subsidy benefit. Add the total benefit, use exchange rate, convert it, then discount it using 5% and find the present value. This is the total present value. Once you find out, you should know how you got the annual tax shield and subsidy benefit. So annual tax shield is interest into loan into tax rate. This is the interest, this is the loan, this is the tax rate. Next, interest into loan into 1 minus tax rate. This is the subsidy benefit. Subsidy benefit and annual tax shield, the way you calculate is different. Right? So that's it, you have to understand. By now you must be a pro in all the calculations and you